Welcome to the Fiscal Physical Podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of the Fiscal Physical Podcast. My name's Aaron. I am joined, as always, by the published author Ryan Nelson, founder of Alchemy Wealth Management, and we are so excited to be with you guys this week and bringing you some financial literacy options that you could we know there's a lot of podcasts out there, so hopefully you guys will find this one engaging, enjoyable, digestible. That's what we try to do here to increase your financial knowledge. Once again, we're not trying to give financial advice. Want to make that pretty clear, but we do hope that we can get your brain working and thinking about these topics. And well, sorry, Ryan, how are you?
Doing pretty darn well. How are you?
Not too bad. I was into a tangent there, so I'm glad I brought myself back. Remembered I wasn't doing a solo here, so it would be pretty tough to do this podcast solo. There'd be a lot of dead air, if you will. So, but today, Ryan, we're going to talk about a topic here. It's it's called the behavior gap, and once again, another one of those topics that I saw come up, and I was like, yeah, I need to learn about this. I'd like to learn about this here. And so I really don't know much about it. So I'm hoping you can kind of, share with everybody what your thoughts on it are and kind of break it down for us here.
Yeah. So the behavior gap, I think this is largely credited to Carl Richards, and I think he defines it better than I ever could. So this is Carl Richards' definition of the behavior gap. It's the difference between a wise financial decision versus what we decide to do. Okay. So you know how I always say there's like the spreadsheet answer and then there's your answer? Yes. So
I use that so much in my work. Like nice. I learned it on this podcast, and I use it almost daily with my team members.
You're going to get promoted anytime.
Oh, yeah. I should be running it. By the time this podcast airs, I'm probably fired.
Yeah. But yeah, so if we use that same sort of saying, right? So there's the spreadsheet answer and there's your answer. Basically, the gap between those two is the behavior gap. Okay. So the behavior gap's not necessarily bad. I personally don't think every decision should be financially driven, right? So if you're going to go buy a new car, should the only thing you factor in when you're buying that car is be the dollar and cents? Probably not. Now, should it be a factor? I would hope so, right? So you shouldn't just go to the lot and know nothing about your finances or nothing about how anything costs and just pick the car that looks the coolest to you. That's probably wouldn't be a responsible decision, right? But so it really is, the behavior gap is that difference between what would be the best financial decision in the action we actually take, right? So in the instance of buying a car, pretty self-explanatory. Maybe we buy the new car off the lot versus buying the used car. Could be a sizable difference. That would be a sizable difference in cost. That would be the behavior gap. And so, in my practice, I see this most commonly. Most commonly, we refer to this in regards to annualized returns. Right. And so, when somebody's investing, one popular way this might come up is somebody might be planning to stay the course, right? And then the market drops 30%. So they have $1 million. Market drops 30%. They see their account balance at $700,000 and they say, uh-oh, right, I must be doing something wrong. Like I'm probably not investing the right way. I'm probably doing something wrong. Like, okay, let me go make some changes or do something else, right? And that decision may not be a wise financial decision, but they reacted emotionally. And so that could then affect their long-term average returns. And again, that gap between sort of what they quote unquote in air quotes should have gotten and what they did get would be the behavior gap. Does that make sense?
That makes perfect sense, man. The way you kind of broke that down. And I'm glad you were able to bring up stay the course as well, too.
Oh, of course.
Huge. Yeah. And that was one of my questions I was going to ask, is how often do you see this in your practice? I'm sure that you see it all the time where people get worried or they, I sure can go the other way where they get super excited about but mainly I'm guessing when they're like, oh, this is not working or this isn't, it's like, well, we're in year 2 of a 30-year plan here, boss.
Right. Yeah, yeah, exactly. Yeah, no, I see it. I don't know about every day, but it certainly feels like every day. And yeah, so it's a real consideration. And so, as you're zooming out, like you said, I mean, you just want to stay the course. I find there's some interesting data out there. If you just go Google like value of a financial advisor, what I find is probably the biggest value of a financial advisor is helping close this behavior gap. So I can help somebody manage their assets. I can help them figure out their risk tolerance, right? There's lots of things I can do, and all of that adds value. But the thing that probably single-handedly adds the most value is closing the behavior gap. And so when somebody gets a little nervous, and maybe if they were managing their own assets would have sold, the fact that they call me and we have a conversation before they do, helps maybe alleviate the concern, and maybe they don't sell. Or the fact just that they know a professional is dealing with it, and whereas if they were managing if their account's at $1 million, for instance, and they were managing it themselves, but not super confident with what they were doing, and it drops to 700,000, now all of a sudden they start having lots of second thoughts and saying it's harder to stay the course when you're like, I might just be doing the wrong thing. Right. I want to stay the course, but I don't know what's the course, right? Whereas if they've outsourced that to a professional, it goes from $1 million to 700,000. They call in, we say not an issue, we're right on track with where we need to be, we're staying the course. It's a little easier for them to stay the course in that instance, right, and help close that behavior gap. But so it's interesting, I find, if you go I just did some quick Googling here. And so I just Google the value of a financial advisor Vanguard, value of a financial advisor Fidelity. And basically every financial institution puts out these like studies, right? And so from just some quick Googling, again, didn't spend more than like 60 seconds on this because these articles are just constantly coming out and always different numbers. But this quick article I found from Vanguard, it's called Putting a Value on Your Value, Quantifying Vanguard's Advisors Alpha. They found that an advisor can add around 3% returns to their to their clients' annualized returns. Fidelity came out with something. It's a quick line from it. Industry studies estimate that the professional financial advice can add up to 5.1% to portfolio returns over the long term, depending on the time period and how the returns are calculated. So 3%, 5.1%. Again, what I find interesting there, what I try to tell all my clients is like, I'm not some magical stock picking guru, right? The market is really what's dictating the returns. What we do is we figure out how much risk is appropriate, and then the market dictates how much return we get for that level of risk. So this 3% or 5.1% or whatever the actual number isn't coming from financial advisors somehow out stock picking the market. What this is coming from is largely the behavior gap, is helping our clients stay the course. And so, yeah, I find it pretty interesting. And I mean, certainly there's some value there. And that behavior gap is, I think, a little bit bigger than most people would probably think.
Oh, I think so as well. I think that just, if I was managing my own finances specifically, and once again, not my full-time job, not my background that I have, and something, goes awry, or I lose 30%, whatever it might be, I think that the worry that I would have, there's the kind of the freak out that I would have there, be like, oh my gosh, I need to change my plan. I need to do something different. Versus like if I call like a professional and we're like, no, we built in these are going to happen. There's going to be peaks and valleys, and just knowing that this is something that you or a different financial advisor does full time. They have probably seen hundreds of cases of these certain things. Versus myself, I only
might
have
be the first time you've seen it.
First time I've seen that big dip in maybe my retirement, whatever it might be. So that's why for myself, like I don't log in and look at my fine. I look at them like once a year because I'm just like, oh, cool. Like, whoa, look at that. Where'd all my money go? But I think that it's just knowing what you should do, and like, the spreadsheet answer, and then the actual like bridging that gap in between the two, because I feel like the answer is always going to be right in the middle of where somebody probably goes. And so that's a really good way of putting that's like the behavior gap specifically there.
Exactly. So let's give you a little quick trivia here as well. So this is interesting. So if you just look at some sort of benchmark like the S&P 500, so if you were to invest in the S&P 500, look at what it was worth 20 years later. It's really easy to see, right? In theory, that's sort of what your return should be if you invested in the S&P 500 over the same 20-year period, right? So there's all this data out there around average investor returns and what the benchmark returns were. right? And so the average investor, some should do better than the benchmark, some should do less than the benchmark. In theory, you would think the average investor should just get the benchmark returns.
That makes sense,
right?
Yeah.
And so this is data over the last 20 years.
Okay.
So in stocks, don't pay too much attention to these percentages because we could, the next 20 years has nothing to do with the past 20 years. But over the last 20 years, stocks averaged 10.65%. So a benchmark holding stocks averaged 10.65%. What do you think the average investor who invested in stocks over that 20-year window got?
Oh boy, let's see. So the average investor that I'm guessing it's going to be less than that. I'm going to go with 5%.
So 7.13.
Okay.
So they averaged, the benchmark was 10.6. They averaged 7.13. So that difference is 3.5% in this particular study or example. So that difference of 3.5%, it's the same investments.
Right.
The difference is when they bought, when they sold, they didn't necessarily stay the course for the entire time. That difference is the behavior gap, right? They took some behavior over that 20-year window that decreased their earnings by an average of 3.5% per year.
Right.
Right. They were in the same investments. The difference is just what actions they took. So the behavior gap there was 3.5%. We'll do another quick one just since I got it in front of me here. So the average return for fixed income or bonds, we will call them, for that same 20-year period was 5.29%. So we'll call it 5.3%. What do you think the average investor got?
4%.
0.34. The gap there was almost 5%.
Oh my gosh.
Yep. So again, they're investing in the same assets. If they just bought and hold, they would have got 5.29%. The average investor got 0.34%. The difference is the behavior gap. They're taking some behavior there in their fixed income investing that resulted in 5% loss almost in returns, right? So yeah, it's fascinating. And you can find these all the time. One I didn't pull up. Let's see if I can find it real quick. Dalbar, DALBAR. You could just look up Dalbar returns, average investors and stuff. There's all sorts of different companies that report on this, but it's super, super fascinating. And that behavior gap is so much bigger than you would think it would be.
Yeah. It reminds me of there's a line from the movie Men in Black, and I'm going to butcher the line probably, but it talks about like the idea of like that aliens are out there or whatever, and they're like, we should share it with like the public. And one of the agents is like, no, there's no way we should. People can't handle it, and they're like, oh, definitely people can handle it. They're like, no. A person might be smart, but humans in general, population, are skittish, like panicky animals. Is like what they say, and so like the vast majority of that can be like that shows it just in those numbers overall of like, oh, like if somebody was to tell me, hey, I can get, I don't want to say guaranteed because nothing's guaranteed, but 10% by just holding and staying the course. Like in my mind, I'm like, oh, okay, cool. That sounds good. Like, but if I was, I looking at my portfolio and I'm like, whoa, everything's down here. I got to switch.
Yep.
And now I'm potentially losing out on 3%, 5% if it's bonds, like over the course of the time. Like that's so interesting to think about that.
Well, as long as we're talking Men in Black quotes, let me give you one other one.
Okay, excellent.
This is like one of my favorite Men in Black quotes. At least if I remember right, it's up there. But so they say 1,000 years ago, everybody knew the Earth was the center of the universe. 500 years ago, they knew the Earth was flat. 15 minutes ago, you knew humans were alone on it. Imagine what you'll know tomorrow. And it's just so true in investing and everything, right? It's what we think we know today. People 100 years from now will look back on us and say, "Gosh, what were they doing?" You're right. So yeah, it's always probably beneficial to keep that open mind and yeah.
No, that's excellent, Ryan. That's I'm glad we got into some movie quotes as well too. That's phenomenal. So we'll go ahead and take a pause here. We'll be back on the other side of this, and everybody hang tight with us.
And now, to put the personal in personal finance.
All right, Ryan, welcome back to this side of the Fiscal Physical podcast. We are in the personal section here, and this is one that I'm very interested to get your thoughts on here. And obviously, we're not trying to promote anything or whatever it might be. Nobody's sponsoring this yet. And so I'd like to hear, though, Ryan, just do you have a specific brand or company that you really enjoy their product, or they provide you something, a service that you're like, hey, I really enjoy it, my experience overall with this company or brand?
Yeah, nothing really comes to mind. I'm not like a huge like label type guy. Sure. I don't, there's not a ton of things that really come to mind that like where I resonate really with like a brand. Mm-hmm. Yeah. So, I mean, I guess the short answer is no, not really. I will say there's a couple of things like the Green Bay Packers.
Right. Definitely.
If you're going to consider that a brand, which mm-hmm. I would, probably a less conventional brand, but, I'm just passionate about the Packers themselves. And so like them, mm-hmm. like what they stand for. It's a small market team. It's owned by the fans. Like there's lots of things about the team that I think are cool.
Yeah.
And so, I like the Green Bay Packers. Also Ironman is I think Iron Man did a really cool job of branding. Yep. And, when I tell people I do Ironmans, they almost think that's synonymous with triathlon. Right. A lot of people will think, and I think that an Ironman is the sport of swim, bike, and run, but the sport of swim, bike, and run is triathlon.
Right.
Ironman is a brand that puts on triathlon races, right? And so it's pretty cool how well they've branded themselves. And they've, the Ironman brand, the triathlon races they put on are sort of ultra endurance, very long events. And I think they've done a good job of sort of, like emphasizing the toughness of the mm-hmm. challenge, which I resonate with. So I'd say like the Green Bay Packers and Ironman are two brands or companies that I suppose I resonate most with. What about yourself?
It's an interesting piece of like, sometimes when a brand takes over like what a product is. It's so interesting to see like when somebody's like, oh, like,
Google.
Google, exactly. Yeah. I'm just going to go Google. I'm going to go on Google. And it's like, well, actually you're going on the internet, but like, or like when somebody's like, oh, like, can you pass me a Kleenex?
Yep.
It's actually, you're passing them tissue paper is what it is. But Kleenex is just the brand that's taken over. You're going to clean your ears with something. I say a Q-tip. A Q-tip's a brand. Like the product is like
Band-Aids.
Exactly. Yeah, stuff like that. So it's when you can get to that point where you are synonymous with the product, you've made it. You've made it. Yeah, that's the goal overall. So
which the Packers I think are synonymous with Super Bowl wins.
Yeah. Well, sure. All right. Yeah, we'll edit that out. Yeah. No. But for myself, like I'm very similar. I'm not a big brand guy. I find something that I like. And I tend to stick with it. I'm pretty simple as far as that goes. One thing that I am pretty passionate about now that I never was before is there's this company called Built. It's like BYLT.
Oh, yeah, I've seen.
And they make the best underwear.
Oh, yeah?
Like, it's phenomenal. Like, I've worn different kind of underwear. I used to just wear cheap cotton stuff, whatever. But, like, as I've gotten older, I'm like, I kind of want to be comfortable. And I sit a lot. And Built, the brand, is just like, awesome. I really enjoy their products. They hold up well. They also make shirts and stuff too. The shirts are fine, like they're whatever, but like the underwear, I'm just like, I don't think I'll ever wear any other underwear again.
That's
too.
Funny.
So it's
not to be construed as financial advice.
Exactly. Yeah. Good point. Yeah. Yeah. Or you could just not wear underwear, whatever. Up to you. Yeah. But that's like it. I don't have many brands that I like resonate with, or I'm like, I love that. But like when I find something that really works for me, I'm like, oh, I like that, and I'm gonna continue. And it's just weird stuff that I like find too. Right. So, or simple creatures in a way, I would say. So, awesome. Well, thank you so much, Ryan. Once again, thank you to all our listeners out there who are tuning in, checking us out here, and find us on Spotify, Apple Podcasts, pretty much wherever you get your podcast. And Ryan, I'll leave you to wrap us up here.
As always, stay the course.
Thank you for joining us for the Fiscal Physical Podcast. Until next time, happy listening. And as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode. And consider leaving us a rating and review on your favorite platform. This helps other listeners like you Find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your Fiscal Physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.